Have you ever pondered over the amount of money you need to invest to earn $1,000 per month in dividends? It's an intriguing concept, isn't it? Understanding how the investment process works and the potential returns it can yield is crucial in today's world. We're talking about the power of dividends here, the financial magic that could potentially provide you with a steady income stream. So stay tuned as we demystify the process of investing for dividends. Before we dive into calculations, it's crucial to comprehend what dividends are. Dividends are essentially a portion of a company's earnings, distributed to shareholders as a token of gratitude for their investment. They're like a thank you note from the company, but in cash, typically paid out on a regular basis, like quarterly, semi-annually, or annually. Now, why do companies issue dividends? Well, it's a strategic move. Dividends can be an alluring factor for investors as they offer a steady stream of income in addition to any potential capital gains from the rise in stock prices. They're a sign that a company is doing well and has surplus profits to distribute. And the benefits for investors? Dividends can provide a regular income, reinvestment opportunities, and are a cushion against market volatility. They're a significant part of the total return from investing in shares. Now that we understand dividends, let's delve into how much money you need to invest to earn $1,000 per month. The key to calculating the investment needed lies in understanding the dividend yield. Now let's break it down. Dividend yield is a financial ratio that indicates how much a company pays out in dividends each year relative to its stock price. It's a way of measuring the income you're getting back for each dollar invested in a company's stock. So, how is it calculated? Simple. It's the annual dividends per share divided by the price per share. Let's say we have a company that pays out $2 per share annually in dividends, and its current share price is $20. The dividend yield would then be 2 divided by 20, which equals 0.1 or 10%. This percentage is significant because it tells you how much bang you're getting for your buck. A higher dividend yield means you're getting more return on your investment. But here's the catch. The dividend yield isn't static. It changes as the price of the stock fluctuates. If the price goes up, the yield goes down and vice versa, so you need to keep an eye on it. Now let's relate this back to our goal of earning $1,000 per month in dividends. The amount of investment needed depends on the dividend yield. If the yield is higher, you'll need less money invested to hit that $1,000 mark. If it's lower, you'll need more. Let's illustrate this with an example. If you invest in a company with a dividend yield of 4% to earn $1,000 per month, or $12,000 per year, you would need to invest $300,000. But if the yield is 6%, you would need to invest only $200,000 to earn the same amount. Remember, the yield is just one piece of the puzzle. It's essential to consider other factors, like the company's financial health and the stability of its dividends, before investing. With these fundamentals, we are now ready to calculate the investment needed to earn $1,000 per month in dividends. So, how much money do you need invested to generate $1,000 per month in dividends? Let's break it down step by step. The first thing we need to look at is the average dividend yield. The dividend yield is the ratio of a company's annual dividend compared to its share price. In simpler terms, it's the percentage of your investment that you'll get back each year in dividends. Now, the average dividend yield can vary quite a bit, but let's use a figure of 3% for this example. This is a fairly conservative estimate, making our calculation more realistic for the average investor. So, if you're aiming for $1,000 a month, that's $12,000 a year. If we divide this annual goal by our dividend yield, we can calculate the total investment needed. In this case, we divide $12,000 by 3%, and voila, the result is $400,000. This is the amount you would need to invest at a 3% dividend yield to generate $1,000 a month in dividends. But let's not forget about taxes. Depending on where you live and your personal situation, you may have to pay tax on your dividend income. For example, if you're in a 20% tax bracket, you'd have to earn an extra $200 a month to cover the tax, pushing your investment goal up to $480,000. It's also crucial to remember that dividend yields can change. Companies can increase, decrease, or even eliminate their dividends, which would alter your income. Therefore, it's essential to diversify your portfolio and not rely solely on dividends for income. Remember, this is a simplified example, and real investment scenarios can be more complex. Investing involves a lot of variables, and it's important to do thorough research and potentially seek advice from a financial advisor. This calculation is a starting point, but the road to earning $1,000 a month in dividends is a journey that requires careful planning and strategy. There are several factors that can influence your monthly dividend income. First off, one of the key factors that can affect your dividend income is the stability of the company you're investing in. A company's financial health can greatly impact its ability to pay dividends. Companies with steady, predictable cash flow are often better equipped to distribute dividends consistently. So, scrutinize a company's balance sheet, assess its debt levels, and evaluate its earnings before you invest. Another factor is market volatility. The ups and downs of the market can affect a company's stock price and, by extension, its dividend yield. Remember, dividend yield is calculated by dividing the annual dividend payment by the stock's current market price. So, if a stock's price plummets, its yield shoots up, and vice versa. But don't get too excited by high yields. They can sometimes be a result of a falling stock price, which might indicate trouble for the company. Changes in dividend yield is another factor to consider. Companies aren't obligated to pay dividends. They could choose to reinvest their earnings back into the business instead of paying it out to shareholders. Or they might reduce their dividend payout if they face financial difficulties. Also, if a company's earnings grow, it might choose to increase its dividend payout. Therefore, changes in a company's dividend policy can significantly affect your dividend income. Also, don't overlook the impact of taxes. Dividends are typically considered taxable income, so you'll want to factor this into your calculations. The tax rate on dividends can vary depending on a number of factors, including your total income and where you live. Lastly, the frequency of dividend payments can affect your income. Some companies pay dividends quarterly, others semi-annually, and some annually. A few even offer monthly dividends. The more frequently dividends are paid, the faster your reinvestment can compound. Understanding these factors helps in making informed investment decisions. So, before you set your sights on earning $1,000 a month in dividends, take some time to understand the factors that can influence this income. It's not just about how much money you invest, but also where you invest it, how the market behaves, and how the companies you've invested in perform. Earning $1,000 a month in dividends might seem daunting, but it's not impossible. We've covered quite a bit of ground in our journey towards understanding how you can reach that coveted $1,000 per month mark in dividends. Let's take a moment to retrace our steps and reflect on the key takeaways. We started by delving into the concept of dividends, understanding them as a portion of a company's profits distributed to its shareholders. This is a rewarding mechanism that companies use to share their success with those who have invested in them. Then, we navigated through the math behind dividends. We saw that the amount of dividends you receive is primarily determined by two factors: the amount of money you've invested and the dividend yield of the stocks you own. It's a simple multiplication, but the implications are profound. This led us to the crucial task of calculating the investment needed to earn $1,000 a month in dividends. Remember, the dividend yield and the amount you need to invest are inversely proportional. The higher the dividend yield, the less money you need to invest, and vice versa. However, it's paramount to note that a high dividend yield is not always a green light. This is where we discuss the various factors that can affect your dividend income. It's essential to conduct thorough research and understand the company's financial health, the sustainability of its dividend payments, and the overall market conditions. We also emphasize the importance of diversification. Don't put all your eggs in one basket, as the saying goes. Splitting your investments across various sectors can help mitigate risks and provide a safety net. Now, the road to earning $1,000 per month in dividends is not a sprint, it's a marathon. It requires patience and perseverance. You might not see immediate results, but with time, as you reinvest your dividends and compound your earnings, you'll see your portfolio grow. Keep in mind that investing in dividends is not just about the money. It's about financial independence, stability, and building a secure future. It's about making your money work for you. The journey might seem intimidating, but remember, every journey begins with a single step. Start small, learn as you go, and gradually build your portfolio. With the right strategy and patience, you can build an investment portfolio that brings in a steady income in dividends.